Hello everyone, I am Gautam Mitra. I am introducing on behalf of OptiRisk our three presenters this morning or this afternoon. That's myself from OptiRisk Systems, Professor Timo Pennanen from King's College London, but right now he is in Helsinki, so he is speaking from there after me. And finally Alex Fleischer of IBM France, and he's in Paris. He will be the last presenter or last speaker. So we're glad that so many of you have signed up and joined. This is a foretaste of half-day forum that we are going to do at IBM Center later, well actually in April of this year. So the schedule is as follows. I'm going to spend around 20 minutes on introducing stochastic programming and its application to asset and liability management. And after me, Professor Pennanen is going to pick up on the same theme of stochastic programming, but looking at its application in the general insurance. And finally, Alex from IBM France is going to talk about collateral optimization models which are in use for banks. So tall order, we're going to trying to cover quite a lot, and so here it is. Now the outline of my presentation is as follows. I'm going to first briefly go over the background, then introduce concept of decision making under uncertainty, aka also known as stochastic optimization. There are others as well, like robust optimization, but we'll only stick to stochastic. And we're going to illustrate it with an example from asset liability management. And finally, I'll make it ready to hand over to Timo. So the message is as follows, that whereas linear integer optimization have been around since 60s, and only after 80s with spreadsheet optimization, you could really show proof of concept as business school toy models were updated. And many robust modeling tools like Ample, GAMS, Open Studio came into use, and really, industry-trained powerful solvers like Cplex and Grobe, etc. went on, that we found a lot of application optimization. Now, the construction of optimization-based decision support systems have become reality, but they might, in a rather flippant way, introduce the concept of stochastic optimization, and quoting from Lewis Carroll, the time has come, the world has said, etc., until it finishes betting, and whether pigs have wings. We want to give wings to stochastic optimization, and in my opinion, it is now coming of its age, and it can fly. So optimum decision problems under uncertainty and risk, that's the theme. We're also able to process, solve, and evaluate them for decision makers. Now this is a key concept, that we not only make decisions, but we also downstream do evaluation and do risk computation and risk management. So it's about giving stochastic programming away, and let's see how. So starting at the beginning, very well known and the basic models for optimization, that's linear programming, is stated in this very simple matricial form: maximize object from X equal to X, non-negative, etc. But what is more relevant in the context of industrial modeling and decision support system, that we go through a series of steps where you conceptualize the problem by discussing with the problem owner, decision maker. Then you connect it to the data that's around with data modeling. Then you construct the algebraic form of the model, translate to modeling language, and I think we would introduce this concept of modeling language even in SP, why it's relevant. And then you get the result in machine readable form, and perhaps you don't get it right first time, so it goes through the loop. So this hierarchical and related process is very relevant in the industrial domain. Now, decision making under uncertainty has two major components. That one of uncertainty and that of time. And that's where the major, if you like, modeling as well as theoretical developments have taken place. So the way to look at it is many decisions has to be taken today about what will be the outcome tomorrow. And so that's uncertainty. And also this temporal separation, standing here, making decisions which will have realization in future is an important, if you like, determinant. So what people have done, quite naturally, to take robust strategic decision now, followed by rolling contingency plans as different futures outcomes. You know, one thing we don't know what future will be, and hindsight, as you know, is very well known. So the decision you take now is called first stage decision, and this is within a framework of what we are going to present as a two-stage stochastic program or even multi-stage stochastic program. And as future unfolds, you take corrective action and you get a recourse action. And this is captured in the modeling paradigm. So let's do some mathematical notation. It's also hopefully be of use to Timo in his part of the presentation. So whereas linear program had one set of deterministic or known values, which are expected values of the objective function coefficient C, the topology coefficient A, and right-hand side lemma or something or B, in the probability space, in the domain of uncertainty, we have omega FP probability space, where omega denotes the realizations of uncertain parameter, and P omega is the corresponding probability. And so, for notational purposes, we say that there is not only one A, B, C, but omega defined over capital omega, number of realizations. You don't know, but one of them in our world will take place. And we put them in vectorial form, so xi captures ABC omega and xi omega. So that's notational purposes. Now there are alternative models for stochastic programming, and because it's a tour de force, rapid fire, I'm going to summarize them very rapidly. So the single-stage stochastic programs where you do not have the corrective action, but you still take cognizance of the fact that you're going to be uncertain in the future, and that's Markowitz model. Then you've got two-stage stochastic program where there's a corrective action goes in, that's a recourse. Then multi-stage, which happens in every stage, the corrective action. Now there are other ways of describing decision-making under uncertainty, and there is chance constraint programming. It's extended to integrated chance constraint programming, and robust optimization, the last being a situation where you do not make assumption about your uncertainty models or uncertainty, how the uncertainty unfolds. So we are going to look at stochastic linear program with recourse. Is also, in our case, will be two-stage stochastic linear program. And it goes in the following way, that you now minimize an objective function Cx, but also a recourse function, an expectation of this recourse function E omega Qx omega, and Q omega, subject to a set of restriction Ax equal to B. That's so far so good, excepting the recourse function itself can be stated as a linear program in most applications, many applications. So it can be written in terms of a variable recourse or corrective action variable y, minimum f omega y, and subject to d omega y, d omega b omega x, etc. And you note the recourse function depends on x, which is the decision you want to take standing now, the first stage decision. So now if we were to simply algebraically set it out, bringing the two together, you can see your objective function becomes Cx and expectation of f y omega, Ax equal to B, and then B omega, T omega, B omega, C omega, D omega, and it can be expanded to a sort of matricial form in fully written out when there are K realizations of the index set, or that is realizations of the uncertain parameters, and it is written now as a in this following matricial form where you K times these restrictions are set out. And you notice that on the left-hand side is a column. It connects these realizations with the first decision variable X. Now, and then of course the probabilities add up to 1. So the idea is any one of these K realizations and the corresponding, if you like, constraints will apply. Now, if we write down or try to describe it in this form of a tree, then the decision you take here, take now, facing future, is here and now. And the Y's are the corrective actions, and the corresponding, modeling representation, the algebraic coefficient BDDF takes place. You see, so it's so those are the future realizations. And the key thing is the X that we are after. The Y's are simply to improve the decision you make X today, and they are not implementable decisions. Now, so the paradigm of stochastic programming is that of optimum decision models and models of randomness by which you sort of set out the scenarios or those K instances that I've shown you earlier. But it has an inherent assumption that such a model of randomness can be constructed, and thereby you can represent the future uncertainties in some form. And if we look at the data paths within the stochastic programming concept, then what is known as a wait-and-see model is simply looking at each of the realization and writing the corresponding linear program. The expected value of the linear program is simply taking their average, and two-stage stochastic program is where you take the first stage decision to your left and you put in the recourse actions along with it. And I actually, for practical purpose, keep the multi-stage one for the moment. Now we want to get into the domain of asset and liability management and see how we can apply this tool. Now, asset and liability management is the practice of managing risks that arise due to mismatches between the assets and liabilities in many domains. We'll list them in a minute. And asset and liability management is a strategic management tool to manage interest rate risk, blah, 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 the other risks. And many financial services companies use it, at least the downstream for the risk management. So these are typical application areas: bank credit portfolios, bond issuance, university endowment funds, hedge funds, wealthy individuals or individual asset management, insurance companies, Tim will talk about it, and pension funds. And I'm going to briefly talk about the pension funds. Now, what happens in the context of pension funds, and especially known as the defined benefit scheme, where your pension, you get it connected to your salaries when you retire, like myself, but I'm still carrying on with the other direction. You get contribution to the pension fund by active employees and new employees joining. But then you have outflow for disabled members, retired members, widows and orphans. But by and large, they go out of kilter. So meaning they don't match. That means the requirement for payments to obligations are not commensurate with the money that's in there or being earned. And therefore, you need to, the scheme managers have to inject cash. So in the domain of asset and liability management applied to pension funds, you get models of randomness by which you define the asset and liability, and then you construct the optimum decision model by which you take the decision today. And typical models, now going back to a family of stochastic programming models, could be stochastic program 2-stage, or even chance constraint program, or integrated chance constraint program, where what you do, you look at the expected shortfall as opposed to the shortfall you're doing the chance constraint program. So back to the cash flows. As you know, in finance, cash flow is king. So we look at inflows, adding to the wealth of the pension fund, and the outflows, as we show in one shot, and now this takes place over time. And possibly one of the objectives could be to maximize surplus wealth, which is asset minus present value of liabilities minus present value of goods. So the point is, we can capture this in a modeling language, or we can, in the very beginning, I was showing you modeling language by which you can describe this problem. So when it comes to capturing it and describing them, you could simply write it in this set, index sets, which to do with assets, scenarios, time periods, risk groups, and parameters would be price, which is of course stochastic, liability, again stochastic, and hell of a lot of effort goes in describing this, and then probably scenario, and it goes on. I don't want to give a lecture or give them the time to complete this now. So I'll finally make the decisions. Here and now decision here, amount to hold, amount to buy, and to sell, and so forth. And it can be quite easily, we have got a stochastic ample extension of MPL by stochastic. You can write it in that form, but you can also do it in other modeling language, like in IBM Opal Studio, Opal syntax. You could also present it in this form. So this algebraic form that you can do it that way. So it goes on. In a way, how much time have I got? Okay, 5 minutes. So I want to really rush through this and go to the next concept. And that is what I mean by stochastic and robust optimization comes of age. There are many models, modeling and solver systems. I've listed them quickly here. And so in effect, what's happening, people are migrating to those instances where you can apply stochastic programming, and particularly asset liability management or pension funds and insurance and so forth. Now, in order to complete my part of the talk, I want to introduce to the following concept, that it is all about modeling, and modeling can be broken down in the following taxonomy. There are descriptive models by which is a set of mathematical relations by which you define and predict how a physical and industrial or social system works. Normative models, which constitute the basis for quantitative decision making, as if logically scrupulous superhuman does it, and quite often it may not be implemented. Then comes the prescriptive models, which involve systematic analysis of problems as carried out by normally intelligent persons who apply intuition, judgment, and two distinctive features, and this is where SP comes in, is uncertainty analysis and preference analysis. Now, a combination of normative and prescriptive models make what we commonly call decision models. That is, it's a derived category, and it's about defining the decisions. Now, why is it relevant? Because if we go back to the schema I gave right at the beginning, we have to look at the data. We have to then construct the decision model, and we also have to do kind of simulation and evaluation of the decision. And here it comes in. So we are making ex-ante decision, standing here looking at future, applying stochastic program or robust optimization. And we also down the line, and so that's a decision model where you need to do also ex-post evaluation or simulation to see how that would work out. So whereas left-hand side in blue is in-sample decision, the one to the right-hand side is out-of-sample evaluation. Now this is by the way, the slides will be there. I'm flying through them. as I told you, to make SP fly. So it shows how stochastic program and others are connected. Robust stays on the side as well. But this is the thing, that in order to do stochastic program, you need to analyze historical data and create a data path and fit a descriptive model for scenarios, so you can describe the historical data and generate scenarios for future data. Then make decision using stochastic program. Let's not worry about dynamic program and so forth. And finally, you do backtest on these descriptive on these decisions you have made. So this is a kind of modeling paradigm which is now come to be accepted. Now look at this decision, if you like, engine. To the left, we have got tools by which we can make ex-ante decisions, expected values at the LP or two-stage, multi-stage, etc. until robust. We are more or less done, I'm being indicated. There are scenario generators we have done from historical data, and the results which come out are looked at by statistical measures, variance, or stochastic measures, risk measures, and so forth. So I'm almost coming to the end. Here are the conclusions. The models and tools for decision making under uncertainty optimum decision have matured. That's the key thing. It's here to stay, and you can apply it. Many people do without fully realizing, like Markowitz type model. For more information against SPC, we have workshops. Sorry, a commercials, as you can see. The domains of supply chain logistics we are not so interested in. Quants may use SP modeling support for rapid prototyping. Now, a particularly valuable aspect of scenario-based SP is the dual paradigm, ex-ante optimization followed by ex-post decision evaluation. Okay, we are partners of IBM. We are together exploring this field and want to have many applications. And IBM Optimisation Forum for the financial services sector is scheduled for 10 April. I am going to conclude here, and we are going to hand over the presentation to Timo, who is, as I said earlier, is at Helsinki. So over to you, Timo. Okay.
Well, thank you very much, Gautam. You gave a very nice introduction to my talk as well, since I will be looking at stochastic decision-making problems as well. I hope you can see my screen now, or my slides. So there's the title. And I would be looking at, like I said, stochastic optimization, but I will have a slightly narrower view than Gautam did. I will be looking at applications in insurance. So here on the first slide I listed some typical problems that people in insurance company are interested in, and these really go into the two core operations of every insurer. And typical questions are something like, what is a necessary reserve for given financial liabilities, something like insurance liabilities or pension liabilities, which I will be looking at later on. And another separate but closely related question is pricing of insurance products. So here, instead of looking at accounting values of financial liabilities, we are looking at the prices at which an insurer should transact. For example, when an existing insurer is selling new insurance, what are the prices that they should ask for their products? And this, although closely related, it is really a separate issue from reserving. And if any of you knows financial mathematics, you may find this a little bit confusing, since typically in math finance you don't distinguish between these two notions. If you look at textbooks on financial mathematics, they usually just talk about pricing, but sometimes they are not completely clear about what they are talking about. So I will try to make this distinction explicitly, because I believe that this is a very important issue in practice. And I will try to convince you that both these valuation problems come down to asset liability management, very much like what Gautam described earlier. And the reason is that when an insurer is taking care of its existing liabilities or is considering entering a transaction where he sells new insurance, he always faces the question of how to invest his wealth. And then to do it well, to come up with as low as possible prices, you should of course invest your wealth cleverly. And this takes us to optimal investment, which can be formulated as a stochastic optimization problem. And again, if any one of you knows some finance, you probably already realized that this is what I'm talking about is very close to what goes on in the Black-Scholes-Merton model, where one is trying to price an option using the principle that the price should be the least amount of initial wealth that the option seller needs in order to hedge or replicate the cash flows of the options by trading in financial markets. But unlike in classical option market models, insurance liabilities cannot be replicated, and that makes the problem somewhat more complicated, and these problems cannot be solved analytically like the prices of European options can be solved in the Black-Scholes-Merton model. I listed some references here on the second slide. There's a classic book by Hans Bühlmann on insurance mathematics already from 1970s, where he talks about similar issues. But it's an interesting thing that this clearly was published before the Black-Scholes model, but you can see if you look at the book close connections to the option pricing theory. And that's one of my favorite references in insurance mathematics. And there's more recent paper by Arsner, Delbain, and Koch-Medona where they look at this, they take this hedging point of view for determining reserves for insurance liabilities. That is actually very close to what I'm looking at. But the main difference is that they were looking at a single period static model, and that's somewhat easier to deal with. But the issues and the notions are the same. And then there's a very nice collection by René Carmona. He edited a book on indifference pricing where there are many good papers on the pricing of insurance products. And this relates to the other question that I had on my previous slide, namely the pricing of new insurance products. And then the remaining references, the first three on this list, 4, 5, and 6, they are more on the mathematics of what I'm going to talk about in my presentation today. And then the last three references are more on the implementation of these insurance models, how we develop these models and how we implemented them for pension insurance. And that's more the focus on my presentation today. So I will start by describing the model. So this is a multi-period model where in the first stage you are look at an insurance company or an insurer in general who has some financial liabilities. You may think of, for example, a life insurer who has already sold some insurance products to its customers, and now he has collected the money, the premiums, and he is now liable to pay the insurance claims in the future. Now we'll be looking at the finite discrete time with capital T time steps. And the amount of money that the insurer has to pay at time T will be denoted by CT. And every time the insurer makes a payment to its clients, the insurer may invest the remaining wealth that he has into financial markets. And Assume that there's a finite set of assets that the insurer invests in, and I denote the returns by this capital R. These, as well as the claims, are random variables. And the random variables will be modeled as stochastic processes or sequences of random variables in some given probability space. And this would be the descriptive model that Gautam describes in his presentation, where the aim is to come up with a probabilistic model for the uncertain factors in the decision problem. And then the decision problem involves the choice of the investment portfolio at present time and in the future. This investment strategy determines, together with those random variables, the returns and the claims, the amount of wealth that you will have remaining in the future. And your aim is, in asset liability management problem, to manage your assets, your investment portfolio, so that the proceeds of your investment strategy corresponds to the liability payments, the CTs, as well as possible. Now this is roughly the asset liability management problem. And this is written mathematically on page 5. And here the goal is to indeed manage your assets optimally in order to optimize your risk profile. And what you see in the constraints are simply budget constraints. You start with some initial wealth, which maybe a bit strangely here is denoted by minus C0. And it's a bit cryptic why I chose this, but it will become notationally handy afterwards. And then the second constraint, the inequality at the bottom of the problem, that's the budget constraint for the dates in the future. So it just means that what's on the right-hand side is what you collect from your investments at the previous date, and on the left-hand side you have what you pay out today, and then the remaining wealth which you again invest in the financial markets. And your goal is to do this so that the risk-return profile of the remaining wealth at time capital T has as nice distribution as possible. And this is measured by this risk measure, B. I will denote the optimal value of this problem by this Greek letter phi, and that depends on your financial position, which is described by your initial wealth and then the liability payments. And I will show in this presentation, maybe I won't have much time for details today, but I will show how these pricing problems that I talked about earlier, they all come down to this particular asset liability management problem, and the prices can be expressed in terms of this optimal value function phi. So what these kind of pricing and reserving problems come down to in practice are essentially solving this asset liability management problem as well as you can. And that is exactly this kind of stochastic programming problem that Gautam described in his presentation. And here is a mathematical formulation of the reserving problem, and under various light conditions you can indeed write it down in terms of the optimal value function of the asset liability management problem. I will skip this. Then I will relate the reserving values to the classical Black-Scholes prices, just to make a connection to classical financial mathematics to show that valuation in insurance is, after all, the same as valuations in financial industry, in banking. And I think this connection is important to make because there's often some confusion about the different approaches in finance and insurance to valuation. And in this presentation you will see that these are really the same things when done properly through this optimal investment problem. I will then also look at the particular case study which consists of computing reserves for a pension insurance portfolio. And this is a real problem that we solved for the Finnish pension industry. And here the goal is to evaluate, to come up with financial values or reserves for the existing pension liabilities in the Finnish pension system. And there are many essential risk factors. What you see in this picture on page 15 is a description of the historical mortality risk. On the picture on the left-hand side you see actual data about Finnish males, about their survival rates over time in different age groups. And this is something you need to model when you build these stochastic optimization problems. And that's what we have done. There's also indexation risk, because the benefits in Finland are linked to price and wage indices, and those bring additional uncertainties. And these are the descriptive models that you have to build. And what you see on the picture on page 16 is the yearly claims, which is now computed by simulation after we have built this stochastic model for the liabilities. You see how the existing liabilities have cash flows associated with them, so that as the older age groups retire, the cash flows go up. So what's depicted in this figure is the yearly cash flows. And eventually when people age and eventually die, then the claim payments go to zero. So in this reserving problem, you're trying to come up with the minimum amount of initial capital that would allow you as an insurer to cover these uncertain claims over time until the maturity. And then of course you need to describe the investment problem, and here's a rough description of how we do that. We model investment returns on different aggregate classes of investments that insurers typically invest in, and these include different kinds of equity indices as well as loans. And these we model with more or less classic stochastic processes or time series model, whatever you prefer. And once we are done with the asset model and the liability model, all the risk factors are modeled together in a single model in order to capture any possible connections between the investment returns and the insurance liabilities. And this, of course, is very important when you are trying to hedge the insurance claims with your investment strategies. If there's no connections between investment returns and the claims, then it is much harder to match those insurance claim payments. An extreme case is a complete market, like the Black-Scholes market. In those models, the connections are so strong that you can actually construct a hedging strategy which matches the claim payments exactly. But in insurance business, of course, the problems are much harder. This kind of exact matching is not possible. And when you go into the pricing, you need to, like said in the beginning, the problem comes down to solving these asset liability management problems, and that of course has to be done numerically. In practice, there are no analytical solutions available for these kind of problems. And a nice feature about this kind of asset liability models is that they are convex. And depending on the risk measure that you are optimizing, they may be even linear. And what you end up with is then a large-scale linear optimization problem for which you have very efficient tools like the Cplex solver or other solvers. But these solvers can really handle large problems with many hundreds of thousands of variables, and that's exactly what you need in this class of problems. And then we got some numerical results after these computations, and this table just illustrates the effect of these subjective factors, like the risk tolerance when you are determining the reserves for liabilities. And then this picture on page 20 basically just depicts graphically the mathematical model that we use for determining liabilities. I think I just ran out of time, so I would stop here and let Alex talk. Thank you.
Hi. Thank you very much, Timo. Now, this is for Gautam Mitra, and I would like to invite Alex from Paris to come in and talk on the collateral optimization aspect of the collateral optimization for banks. Alex?
Hello.
Hi, over to you.
Okay. Can you see my slides?
Yes, yes, we can see your slide.
Hello. So, thanks, Gautam. So, I'm Alex Fleischer. I work for IBM. I'm a tech sales engineer for iLog optimization. My talk won't take very long and won't be as technical as the two talks before. I want to introduce you a new very fashionable problems today. It's the optimization. It's applying the optimization techniques for collateral optimization. And to me, this is speaking with prospects and customers and many people. This is a very trendy problem, and in a way, ALM and portfolio optimization are quite old problem, and many articles have been written on those topics. Collateral optimization is a new field, but in a way, it's possible to optimize the same way as what was done with portfolio optimization. So why is collateral optimization needed now? Mainly because of new regulations like Basel III, EMIR, and Dodd-Frank. So it's not possible for banks and for financial sector to do anything without control, and this control makes liquidity very expensive for them, because there is a maximum leverage on what they can do out of what they have. So they have to make the most out of the scarce liquidity they have. And 5 years ago, liquidity was not a scarce resource anymore. So this is the big change that makes collateral optimization very useful today. And something very important is that the financial sector is not a market where people can wait and do nothing. It is a very competitive market. So in a way, if you don't begin to do collateral optimization, the competition will. So this is why everybody is thinking about collateral optimization. I don't say that everybody is already doing collateral optimization. So in a nutshell, to optimize collateral, there are 3 steps. First, you need to centralize the collateral. So in the old times, how was collateral management done? In fact, when a bank or a financial institution had to pledge some stocks in order to secure a transaction, they would phone someone who would have some stocks and say, okay, can I take your stock and can I use them as collateral? Okay, thanks. So this was totally suboptimal, and the collateral was used as a stack. In fact, there was a big stack with collateral, and it was not centralized. So people were looking for collateral in a very anarchic way. So first, the first step is to centralize collateral. So to have a repository of everything, every stocks and everything that could be used as a collateral, so as something that you can pledge for a transaction, to secure a transaction. Then the second step is to optimize the use of collateral, which means instead of picking any collateral, it's to have an optimized way to know that if you use A as collateral, then in the long term it will provide this and this, and if you use B, then you could be stuck. So there is an optimal way to choose which collateral to use all day long. And the third step, that is sometimes used without the second step, is a retroaction on pricing, which means that if a stock, if an asset has some collateral property, that you can use it as a collateral, then it will be worth more than its exchange value, because if you compare an asset that is 20 euro and an asset that is 20 euro, but that you can use for collateralization, and the first one you cannot, you see that there is an add-on value that you should take into account in your mark-to-model inside. And so those are the three steps. So centralized collateral, optimize use, and then the retroaction on price. So it's more and more interesting. Why? Because of in Europe, because of Basel III, and because in a way it makes banks do more with less, which is good. And more out of this is you add new rules. So according to what the bank is and what the risk profile and so on. So the people they can be interested in adding new rules on the way to push collateral. So for example, some banks may want to spread the collateral among Europe. So if they push some collateral for a transaction, they say, okay, we should have at least 5% for Greek debt and no more than 20% on the German debt in order to have a mix. So they can add rules like this. It's very important also to be able to backtest. So they take the past and they will check that with the new rules they want to try for collateralization, it will provide a good ROI. Same, what they may want to do is to stress test the system. So with the collateral optimization they have, they want to be sure that whatever happens, they won't be at risk. And a useful tool to do that is to move. So something that is done very generally is a Monte Carlo simulation. Instead of that, it's possible, instead of computing something very standard, to optimize each computation, and this is Monte Carlo optimization. So how do we compute the optimal use of collateral? So for each transaction, the bank on has to on OTC, on over the counter, has to provide the enough collateral to guarantee the transaction. So the overall optimization model is a minimized cost, and the decision variables are what should we pledge, and this is considering haircuts, granularity, and mark-to-market and mark-to-model. So this is according to the value of the stocks during the day and the value that are in the model of the bank. So during the day, when the prices change, they have to answer the question how to answer margin calls. So pledge more or get some collaterals back because it's the other way, use repos and so on. And in a nutshell, it gives a huge combinatorial problem where Cplex shows its strength. So how does it work? As in any optimization model, you've got inputs. You have your mathematical model with collateral optimization, and you've got outputs. During the day, this is the way it works. And when you do stress testing and simulation, you have the loop to do what-if analysis. So for this, we have a product, ODMI, we can use to do that. So the equation will be written with the same language. Here you've got some simple portfolio optimization model, but with the same language, we can write collateral optimization models. So let me accelerate because I think I'm a bit late. So we have many, we addressed in the past many classical applications with Cplex and with optimization, but now collateral management is what we call a novel application. So we have a few references. I will give more details in the talk we'll have, the meeting in April. So we have the references we have are a huge European bank who had a huge ROI out of collateral optimization, a large central bank in Europe that is using collateralization, auto-collateralization to make to net transactions that could not be netted otherwise, and the Mexican Central Security Depository, who reduced a lot its amount of needed collateral, and this is a way they won the Edelman Prize a few years ago. And that's it with my presentation.